According to data released by the General Administration of Customs of the People's Republic of China, the total value of China's imports and exports for the period of January to April this year was 13.32 trillion yuan, with a year-on-year growth of 5.8%, a decrease of 1.9% when calculated in USD. However, the import and export volume of foreign invested enterprises, 4.06 trillion yuan, declined by 8.2%, accounting for only 30.5% of the total foreign trade value. Among them, exports amounted to 2.2 trillion yuan, a decrease of 6.9%, while imports amounted to 1.86 trillion yuan, a decrease of 9.8%. This indicates that foreign invested enterprises have experienced a significant decline in their role in China's foreign trade and economy. It is well known that during the Mao era, China operated under a planned economy, with state-owned companies monopolizing foreign trade. After the reform and opening up policy was initiated in 1978, foreign enterprises entered China, diversifying the landscape of foreign trade and making significant contributions to China's foreign trade and economy. In 1991, the share of foreign invested enterprises in China's total import and export value had reached 21.34%. By 1998, the value of imports and exports by foreign invested enterprises surpassed that of state-owned enterprises, making them the dominant force in China's foreign trade and driving China's rapid transformation into the world's factory. However, after 2012, the share of foreign invested enterprises in imports and exports started to decline. It decreased from 46.1% in 2013 to 42.6% in 2018. The trade war between the US and China in 2018 and the outbreak of the pandemic at the end of 2019 further intensified this downward trend. At the same time, in terms of import and export volume, private enterprises became the largest foreign trade entity in China in 2019, with their share rising to 48.6% in 2021 and further increasing to 50.9% in 2022. The continuous decline in the proportion of foreign enterprises in China's foreign trade can be attributed to several factors. One factor is the de-exportization of foreign enterprises and the deindustrialization of foreign investment. In terms of de-exportization, in 2006, the export sales of enterprises reached $563.8 billion, which was 7 times their domestic sales in China. However, in 2020, the domestic sales of foreign enterprises amounted to $1.45 trillion, which was 55% higher than the export value. As for deindustrialization, in 2005, the share of the service industry in foreign direct investment, FDI, to China was only 24.7%. However, by 2020, it had increased to 77.7%. These factors indicate a shift in the focus of foreign enterprises towards domestic sales and investment in the service sector. The de-exportization of foreign enterprises and the deindustrialization of foreign investment can better explain the sustained decline in the proportion of foreign enterprises in China's foreign trade. However, why did the decline accelerate sharply since 2018? This requires looking beyond economic factors and examining political and international political reasons in China. The article suggests that the key lies in the domestic policy paralysis and international tension caused by the leftward shift of the Chinese Communist Party, CCP, which has prompted global supply chain restructuring and a major reshaping of the international trade landscape, leading foreign enterprises to disengage from China. In summary, there are 2 main factors contributing to the sharp decline in the proportion of foreign enterprises in China's foreign trade. Firstly, the global ambitions of the Chinese Communist Party, CCP, have triggered a backlash from the United States, leading to the trade war initiated by the Trump administration in 2018, which reversed China's international economic environment. Secondly, the CCP's extreme zero-COVID policy over the past 3 years, particularly the lockdown measures in Shanghai, have shaken China's economy. Furthermore, the sudden abandonment of the zero-COVID policy overnight and the concealment of unprecedented death tolls have made the international community view the CCP as unreasonable. Thirdly, the deteriorating political environment in China surrounding Xi Jinping's third term during the 20th Party Congress has caused widespread despair both domestically and internationally. Additionally, factors such as China's stance on the Russia-Ukraine conflict and the potential initiation of a war against Taiwan have compelled foreign enterprises to withdraw from China. These factors have also forced significant capital and businesses to flow out of the country. Indeed, foreign enterprises have been facing increasing difficulties in China since 2018, and the decline in the proportion of foreign trade is just one aspect of this trend. The share of foreign enterprises in the profits of national-scale industrial enterprises has also been shrinking. The policies implemented in recent years have not only impacted domestic private enterprises but also affected foreign enterprises. This year, the Chinese Communist Party, CCP, has been emphasizing the importance of stabilizing foreign investment and foreign trade as part of its efforts to boost the economy. However, its actual actions can be described as draining the pond to catch the fish or scaring the sparrows by swatting the grass, referring to overreactions that may harm unintended targets. These actions include increased scrutiny and investigation of foreign enterprises, arrests of foreign executives, revisions to the counter-espionage law to expand its scope, strict control over the release of economic and financial information to the outside world, and more. The CCP has implemented various measures with the intention of controlling and regulating foreign businesses and their activities in China. It is possible that the Chinese Communist Party, CCP, is aware of the consequences of its actions to some extent. However, despite this awareness, it continues with its approach, which suggests that it has largely lost its ability to self-adjust. This could be seen as a sign of its decline or approaching downfall. According to the annual report by the China-Britain Business Council, pessimism among British companies in the Chinese market reached record levels by the end of last year. Even with the lifting of COVID-19 restrictions, the majority of British companies remain cautious and adopt a wait-and-see approach towards new investments in China. On Tuesday, May 23, the British Chamber of Commerce in China released its annual policy paper, PDF. This report will be submitted to the Chinese and British governments to provide information for trade policies and negotiations between the two sides. The report indicates that by the end of 2022, 42% of British businesses in China felt pessimistic about the prospects of the Chinese market. This is a record high, with the proportion exceeding 10% for the first time. Although business confidence has seen some recovery after the lifting of COVID-19 restrictions, increasing geopolitical tensions, slowing economic prospects, and regulatory uncertainties have become major challenges for many companies. The report points out that in the policy decisions of the two sessions, the annual sessions of the National People's Congress and the Chinese People's Political Consultative Conference, both national security and self-reliance have been emphasized. This has weakened business confidence and raised concerns among foreign invested enterprises in China about long-term prospects. 70% of the surveyed companies indicated that they would adopt a wait-and-see approach. British Chamber of Commerce Chair, Julian McCormack, stated to reporters in Beijing, UK companies are willing and hopeful to invest in China. However, there are certain uncertainties, which is also a cause of concern for us based on the survey results. He further added, 70% of companies express that it is still too early to make long-term commitments to the Chinese market. AstraZeneca, BP, Jaguar Land Rover, and Shell are all members of the British Chamber of Commerce in China. Since the Chinese authorities abandoned strict zero-COVID policies at the end of last year, foreign direct investment, FDI, flowing into China has significantly slowed down. From January to April, FDI in US dollars declined by 3.3% compared to the same period last year. The British Chamber of Commerce has called on Beijing to further clarify how new regulations will be implemented, particularly in areas such as data security, ID regulations, and taxation, in order to reduce the gray areas. Beijing has already announced new regulations that restrict the amount of data foreign companies can send overseas. However, there is a lack of clear definition regarding what constitutes important data, sensitive information, and personal information. In recent weeks, the Chinese Communist Party, CCP, has targeted foreign consulting firms under the pretext of national security concerns. Earlier this month, multiple offices of the U.S. consulting firm Capvision were raided and investigated. Chairman Julian McCormack stated that although these laws come with severe penalties, the uncertainty surrounding them makes it difficult for businesses to comply. The Chamber of Commerce is also concerned about the negative impact of sudden policy changes. Even changes that are initially welcomed, such as the Chinese authorities' decision to end the zero-COVID policy in December or delay the income tax reform in 2021, can increase costs for foreign enterprises. Due to a slowdown in exports, China's economic recovery is weaker than expected, and consumers have not engaged in the anticipated revenge consumption. When discussing the current business confidence, Lian mentioned that the wave of relief as the zero-case count ended no longer exists. On Monday, May 22, Jurg Wuttke, The outgoing president of the European Union Chamber of Commerce in China expressed that without undertaking painful reforms to alleviate the growing debt burden and address other structural challenges, China will find it difficult to achieve rapid growth. He said that China has already picked all the low-hanging fruits,